Hey guys, this is a very exciting video for me because this is the first time I'm recording video which is outside the realm of my course, and I'm cooperating with Professor Boroshin from University of Connecticut in the finance faculty department, and we are doing this together. So I'm recording the video based on his slides. So all the credit goes to him for developing this kind of plan. Okay? So what I want to talk today about is about Wacc, right? Which is a weighted average cost of capital. And this is a very important measure in corporate finance. Why is it important? Because let's say that you're an investor and I'm a company, and you're coming to me and you're saying, you know what, I have such a great project, I think you should invest in it, right? So I'm, as an investor, will ask him, okay, what is the return on this project? And he'll tell me X. And I'll ask him, okay, what is the return on your company? If I'm buying your company, what will be the return? If I'll buy your company, if I will buy, your entire company, and he'll say Y, right? And if Y is less than X, if X is less than Y, why should I invest in a project if I can just buy the company or buy a share of the company, right? So this measure, the weighted average cost of capital, right, says to you, it's like the first line of defense whether investors should invest in projects or not, right? And we are now going to explain, or we're going to explore of how to calculate this measure for a given company, right? So the idea behind it is actually easy peasy, right? So what does it mean to own a company? It means that you own its equity, and then you also own its debt. So in a public market, right, if you want to own the company, okay, the company has basically a capital structure, it has bonds that it issues, it has loans that it issues, and it has equities that it issues, right? And if you want to own the entire company, you need to own the equity, but also its bonds. So it's the debt, okay? Now, what will be the return? So if I'm going to go and I'm going to invest in a company, and I have equity, what will be and I have debt, what is going to be my return on this kind of investment, right? So the first thing we need to find out, okay, we need to understand that this is going to be like a portfolio, right? So how we are going to measure the return in this portfolio? Well, this is easy peasy. If RE, right, is going to be the return on the equity, and RD is going to be the return on the debt, right? Then we know, and let's say, to make it easy, we are going to say that this is D and this is D, right? So this is E, this is E. So equity is E and D is debt, right? We know then, right, that E divided by D plus E times R equity plus D divided by D plus E, right, times R the debt, will be the return on my company. Yeah. So for example, okay, say I have equity, the total market value outstanding of the equity, let's say, is $1 million. And the total market value debt outstanding is $2 million. Now, we are going to talk in a moment how to calculate this RE and RD, but let's first assume that we know it. So let's say that this is 5%, and let's say that this is going to be 2%, right? So then it's actually easy peasy. You say, okay, what is going to be my return? It's going to be million. Divide by 1 million per 2 million, 3 million. Times, 5%. Plus 2 million divide by 3 million times 2%. right? So it's going to be 1 over 3 times 5% plus, plus 2/3 times 2%. And, you can calculate this number. I don't want to do it now, but you can see exactly how it is done. So it's actually easy peasy. Now, the one thing that we want to understand, right, is how to calculate RE and how to calculate RD, okay? So for the RD, okay, it's actually easy, right, because it's just the yield. It's just the yield. So if, for example, the debt is issued at par, right, the debt, the price of the debt equals to its principal, right, then you know that in this case it will be just a coupon on the debt, okay? But if it's not, then it's just the yield, of the bonds that you have in the market. Now the only tricky part here, right, that what happens if you have, let's say, cohorts of debt, because if you look on the debt in the market, it's never one bond, it's like gazillion of bonds. Well, it's not a problem, because what you need to do, you just need to have one number, so you can aggregate those bonds, calculate the weighted average yield, and you're done, okay? So for example, if you have two bonds, let's say bond 1 and bond 2, and market value 1 and market value 2, and this guy is yield 1, and this guy is yield 2, right? Then you know that you have market value divided by market value 1 plus market value 2 times yield 1 plus market value 2 divided by market value 1 plus market value 2 times yield 2. Okay? And you're done. Basically, you are done. There is nothing more than, that in these calculations that is going on into, into this kind of things, and it's always will be like a weighted average, okay? Now, the more interesting thing is how I'm going to calculate the risk of the equity, right? So, debt, right, is actually, pretty obvious. Now, one thing that, let's say you don't have a debt, right? Or the debt is not publicly traded. So what you need to do then is to go to your analyst and ask him to estimate, what is the yield on the debt. So what they're going to do, they're going to go for comps, they're looking at comps, they will look on the industry, and they will come up with some, metric. We can talk about this next time. I do not want to go into that. Now, I want to talk about the RE. How do I calculate RE? So there's 3 ways to do it. The first way, CAPM. Second way, dividends. And the third way is a bond yield risk premium. Okay? What is a CAPM? So the CAPM is actually based on the following things. That if you have let's say an equity, right? Then we know, okay, by the CAPM that all the returns of the equity is coming from the market. So then we have the equation that RE minus the risk-free rate equals to some beta times mu minus the risk-free rate. Okay? What is this mu? Mu is your market return. What it is going to be in the United States, for example, the standard is either to look on the S&P index, or you can look on the total stock market index, which is run by Wilshire. Okay? So the market return in the United States is some index of equities, right, which is kind of inclusive. S&P contains a lot of stocks. It's like 60 or 70% of the market value. Total stock market index contains all the equities, So the market return, right? The market return here is going to be some index which is a benchmark for equity performance, okay? And then the beta, right, what you do, you just run some regression. So you have basically time series of your equities, right? Of your equity, let's say it's G, okay? You have time series of the S&P. And then you're using, Excel or some other program to come up with your beta, to run regression one versus the other, right? And once you have that, you can estimate, going forward, what will be the price of equity. Okay, this difference, by the way, is called market premium. And historically, we were able to know that this is around between 5 to 6%. Sometimes it's higher, sometimes it's lower, but you have this kind of range. So for example, say the beta is going to be 0.5, And now the risk-free rate is almost zero. I mean, it's actually very close to zero, is a Fed fund rate or the 1 year, right? So then your RE is going to be around 3%, right? So then your equity, your, the return on your equity will be 3% if your bet is 0.5, right? So that's kind of a pretty straightforward calculation. Now, what are the problems with those calculations? The first thing, right, that beta is notoriously unstable, okay? So if you have a high volatility stock, okay, you cannot determine beta with a very high precision. You will have a huge confidence interval, right? Beta is actually also a random variable which is randomly distributed, and beta has a huge confidence interval, okay? So from that perspective, you don't know beta exactly, so you don't know RE exactly, right? You just have an estimate, you have an expected estimate, okay? And another thing, right, that kind of, also a small problem, that, according to the CAPM includes all markets. The CAPM includes real estate. The CAPM includes bonds, right? This mu must include the entire market. And the S&P is just a small portion, right, of the market, because we have the bond market, which is also a huge portion. So in this particular case, right, beta and mu can change, okay? And then your RE can change as well, okay? So these are the issues that we have, with the CAPM. Now, the other way to do it, right? The other way to think about this is to use the discount growth model, right? And in this particular case, you just say, okay, or discount cash flow, that this is going to be D, right? Your dividend, your future dividend, divided by the current price, right? Plus your growth, right? And this is going to be the dividend growth. So the idea behind this model, right, is to basically use the discount cash flow analysis and say that the stock now, right, reflects all the, all the growth, all the future growth, right? And then if you have an estimate on the G, right, and you have the dividend today, you can actually calculate the return today, which is your here, right, plus the return that, in the future, which is coming from here, okay? So that's actually, also somewhat unreliable, because the problem is to estimate the growth, right? You know the dividend today, but think about your growth, right? If you have an Apple stock, can you estimate its growth? If you have an IBM, can you estimate its growth, right? So this is good for stocks which are kind of what we call value stocks, right? If you have a value stock, then you kind of know what its growth, it's a steady company, it grows its operation, on some constant basis, right? Then you can actually estimate G. Now, if you have a high growth, high tech stock, like a startup, right? It's actually very, very tough. But people are doing it. And the last thing, right, is to use if you have bonds, okay, and then you have the yield on the bonds, you can add what we call the risk premium, right, in order to estimate the return on the equity. What is this risk premium? Okay, so think about the usual, think about now the government, think about the US government, and think about the S&P, okay? So the S&P, okay, is riskier. It has a higher, higher return than the U.S. bonds. Otherwise, it wouldn't be logical to invest in S&P versus investing in U.S. bonds, right? So the S&P, on average, historically, had a higher return than the U.S. bonds. Okay, it had a high return, let's say by 4% or something, between 4 and 5%. People have different measures, sometimes adjusted to inflation, not adjusted to inflation. Let's say that we have 5% risk premium, right? So it means that if you look on the S&P, right, and you on the average historical S&P, long-term average, and you subtract from it, right, the U.S. 10-year Treasury bond, Treasury, which is kind of benchmark, right, for returns of bonds that you invest in the company, in the government, right? You're going to get historically an average annual 4 to 5% return if you invest in this instrument versus investing in this instrument. Great. Now, if you have a company, okay, you have a company, you can think about bonds as corresponding to this, okay, and then you can think about the equity as corresponding to this, okay. So basically, if you invest in the bonds of the company, right, your risk of losing money is much lower, right, than investing in the equity, okay. Because bonds you can hold to maturity, let's say, right? You hold to maturity, and then you don't, and once you get to maturity, you get your principal back. Here, right, equity falls by 50%. Forget about it. It will take years until it will come back, right? So in this particular case, you can think about bonds as being, bonds of this company being corresponding to the U.S. government, as the S&P corresponds to the equity, right? So from that perspective, you can just take, right, the public debt returns that you have here, or the public yield, and add to it, right, the risk premium of the equity versus the government plus 4% or something. And then you're going to get the equity return. Now, I give you 3 ways, right, of how to do the equity. Now, is this good or bad? I think it's good news. Why is it good news? Because you have 3 ways to validate the analysis. One of the most important things, right, that you can do as an analyst when you go to a company is to defend your analysis. If you are doing it in 3 ways, and in 3 ways you are actually getting numbers in the same range, right? Let's say, in the same range, then you can actually present this analysis very confidently to your management. And you can say, for example, take an average. But if you have 3 ways, right, and 2 ways or 1 way gives you a much higher or a much lower number than the other ways, okay, then you need to think, oh my God, maybe there is a problem. And where am I going wrong? Where am I going wrong? Always ask yourself, where are you going wrong, and you'll be golden. All right? So it was great talking to you. And once again, I based this video on the slides of Professor Baroshin from University of Connecticut. Thank you very much, and have a great day. Bye.